Good morning, good evening, and good afternoon, guys. Welcome back to the channel. Today we're going to be going through an investopedia article on what dividends are, the definitions of it in stocks and payments, and how they work. Let's get into the video. Okay, guys, so a dividend is the distribution of a company's earnings to its shareholders. Now, this is determined by the company's board of directors, and dividends are distributed most commonly quarterly and can be paid out in cash or in the form of a reinvestment in additional stock. Now, the dividend yield is shown as a percentage of the dividend's price, such as 2.5% of a company's share price. Okay, so if the price of a share is $100, the dividend price and the dividend percentage would be 2.5%, which would be $2.50. Okay. Now, common shareholders of the dividend are eligible to receive a distribution as long as they own the stock before the ex-dividend date. So it is possible for you to buy a stock during the middle of a quarter and you will still get paid out at the end of that quarter as well. Okay. Because as long as you bought the dividend before the end of the dividend date, which is the cut-off date before the companies go, you were invested too late, you're not getting dividends for this quarter. But dividend payments can be changed, and they are most commonly determined by a company's board of directors. And many companies do not pay dividends as they want to retain the earnings to be invested back into the company instead. Now, as it says here, the definition of a dividend is that it is the distribution of corporate profits to qualified shareholders as determined by the company's board of directors, which we've just gone through just a second ago. Now let's understand how dividends work. Now, dividends must be approved by the shareholders by voting rights. We've gone through voting rights in an earlier video. Now, although cash dividends are common, dividends can also be issued as shares of stock. And various mutual funds and exchange-traded funds, which are otherwise known as ETFs, also pay dividends out. Now, a dividend is a reward that is paid to the shareholder for their investment in the company's equity, and it usually originates from the company's net profit. Although profits can be kept by the company to retain its earnings to be used in the company's ongoing and future businesses, and then the remainder can be allocated to shareholders as a dividend afterwards. Now, companies can still make dividend payments when they don't make suitable profits to maintain their established track record of distributions, and this can be due to a multitude of factors, but most commonly it's wanting to keep the share price up so that investors do not leave as the share price goes down, or because they stop receiving dividends, people will leave the stock and go to a different stock instead, bringing the price down of the stock itself, devaluing the company. Now, the board of directors can choose to issue dividends over various time frames and with any different payout rates. Now, dividends can be paid at scheduled frequency, such as monthly, quarterly, or annually. And Walmart, for example, and Unilever make regular quarterly dividend payments. Companies can also issue non-recurring special dividends, now either individually or in addition to a scheduled dividend. Now, United Bancorp declared a 10 cents per share special dividend on February 18th, 2020, so it does happen. Now, the dividend companies that pay out most common and in larger amounts are normally the larger and more established companies that have more predictable profits, and they are the best dividend payers, okay? So they pay out the most to people who are holding the stock for the dividends. And as you can see, these industries below just here are the big ones other than tech. So you've got basic materials, so that's raw materials like timber and cattle and things like that. And then you've got oil and gas. Obviously, oil and gas makes a huge amount of money. Banks and the financial sector as well. Banks make a fat amount of money, obviously. Now, everyone needs healthcare and pharmaceuticals, and they do charge a pretty penny for most of it. So there are a lot of dividends from that as well. And then you have utilities as well. Now, companies structured such as master limited partnerships or MLPs, and then Real estate investment trusts, or REITs, I don't know if you heard that phrase before, they require special distributions to shareholders, and they may also issue regular dividend payments such as stated in their objectives. So they can issue regular dividend payments, but they do not have to issue regular dividend payments. And then startups as well, such as technology or biotech sectors, may not offer regular dividends, as in the early stages, companies want to keep as much revenue as possible so that they can then invest it and retain it for development and research into further expansion. Now, the important dates for dividends are you need to know when the announcement date is. So the company announces a dividend date or a declaration date that must be approved by the shareholders before they can be paid. Now, the ex-dividend date is the date on which the dividend eligibility expires, and it's called the ex-dividend date or the ex-date. For instance, if a stock has the ex-date of Monday the 5th, then shareholders who buy the stock after that day, so Tuesday the 6th, will not qualify to receive the dividend payments. Now, shareholders who own the stock one business day prior to the ex-date, Friday the 2nd in this example, or earlier, qualify for the distribution. So as I said earlier, if you get this stock before the ex-date, you get dividends, but after the ex-date, which is the cut-off date, you don't get the dividends, but you will get the ones for the next quarter if you stick around for that. Now, the record date is the cut-off date established by the company to determine the shareholders' eligibility to receive a dividend distribution. So this goes in tangent with the ex-dividend date. And then the payment date is the company issues the payment on the payment date of the dividend, which is the money that gets given to the investors. Now, how do dividends affect a stock share price? So dividend payments impact share price, and the price may rise on the announcement of a dividend being declared, and at the same time by a decline of the dividend as well. So the shareholders have decided not to pay out a dividend this month. So the price may rise when they announce a dividend, and then the price may decline when they say they're not giving out a dividend as well. So for example, a company that is trading at $60 per share declares a $2 dividend on the announcement date, and as the news becomes public, they then share price may increase by $2 and hit $62. If the stock trades at $63 one business day before the ex-dividend date, on the ex-dividend date it is adjusted to $2 and begins trading at $61 at the start of the next trading session on the ex-dividend date, because anyone buying on the ex-dividend date will not receive the dividend. Now, this is not guaranteed, but often the price adjusts by the dividend on the ex-dividend date. Now, why do companies want to pay dividends? Dividends are often expected to be paid out by shareholders as a reward for their investment in the company. Dividends reflect positively on a company and help maintain investors' trust. A high-value dividend declaration can indicate that a company is doing well and has generated good profits, but can also indicate that the company does not have suitable projects to generate better return for the future. So it is a catch-22 here, where they have enough money to give out money and give it back to the investors. However, they can also be making enough not be making enough money to where they don't want to put it into anywhere else. So you might get a better dividend, however, they might not have enough money to go and do a bunch of new experiments and a bunch of new research to expand their company. So therefore, it utilizes the cash to pay it back to the shareholders, or they can reinvest it for growth. Now, if a company with a long history of dividend payments declares that a reduction of the dividend amount or the elimination may signal to investors that the company is in trouble. AT&T cut its annual dividend in half to $1.11 on February 1st, 2022, and its shares fell by 4% that day. So that is a real-world example of where if you cut the shares, investors will leave because they're no longer going to be getting the same amount of returns as they expected. However, a reduction in the dividend amount or a decision made against the dividend payment may not necessarily translate into bad news for the company. The company's management may have a plan for investing the money, such to get a higher return project that has potential to magnify the returns to stakeholders in the long run. So they're sacrificing the price of their shares now so that they be able to get a higher share price in the long term and in the long run, by magnifying their profit. Now, dividends can be paid out by various different types of funds, such as bond or mutual funds, and they are different from dividends paid out by a company. Funds employ the principle of net asset value, or NAV, which reflects the valuation of their holdings or the price of the asset that has the fund in its portfolio. A regular dividend payment should not be misunderstood as a stellar performance by the fund, as for example, a bond investing in a fund may pay monthly dividends because it receives monthly interest on its interest-bearing holdings and merely transfers the income from the investment to its investors. So that is all that is. It's not that they're making loads of profit. It's that they are giving all of the dividends that they are receiving, or all of the interest that they are receiving, back to the original investor rather than keeping it for themselves. Now, in a stock investing fund, they pay the dividends from the earnings received from the stock in its portfolio by holding or selling a certain amount of stocks and distributing the capital gains equally. Now, are dividends irrelevant? A bunch of these people up here have argued that companies' dividend policies are irrelevant and have no effect on the price of a firm's stock or its cost capital. I disagree, and as a shareholder, you may remain indifferent to whether the company's dividend policy is the case to why you hold the dividend and the share, or why you do not hold the dividend and the share. In this case, high dividend payments of an investor can be used to buy more shares. So theoretically, if you bought a dividend stock, you eventually could buy another one of the same dividend stock, or take the money out each quarter or each month, depending on what you bought, and then put it somewhere else. Now, if a dividend payout is lean or not as much as you thought, an investor can instead sell the shares to generate the cash that they need. In either case, the combination of the value of an investment into the company or the cash, they will remain the same. Now, this gentleman mentioned above concludes that the dividends are irrelevant and investors should not care about the firm's dividend policy because they can create their own synthetically. However, dividends remain an attractive investment incentive and additional earnings can be made to shareholders. Now, how do you go about buying dividend-paying investments? Investors seeking dividend investments have several options, including stocks, mutual funds, exchange-traded funds as well. The dividend discount model, or the Gordon growth model, can help choose stock investments. These techniques rely on anticipated future dividend streams to value shareholders. Now, to compare multiple stocks based on their dividend performance, investors use the dividend yield factor, and this measures the dividend in terms of the percentage of the current price of the company's share. Now, the dividend rate can be quoted in terms of the dollar amount each share receives per dividend. In addition to dividend yield, another important performance measure to assess the returns generated from a particular investment is the total return factor. This figure accounts for interest, dividends, and increases the share price, among other capital gains. Now, tax is another important consideration when investing in dividend gains, as investors in high tax brackets often prefer dividend-paying stocks for their jurisdiction, as it allows zero or comparatively low tax on dividends. In Greece and Slovakia, they have a lower tax on dividend income for shareholders, whilst dividend gains are tax exempt in Hong Kong. Now, how often are dividends distributed to shareholders? Dividends are most commonly distributed to shareholders quarterly, though some companies may pay dividends semi-annually or whenever they fancy. Payments can be received as cash or reinvestment into the shares of the company stock, which we have gone over just before. Now, an example of a dividend is that if a company's board of directors decides to issue a 5% dividend per share and the company's share is worth $100, the dividend is $5. If the dividends are issued every quarter, the distribution is $1.25, because if you divide $5 by 4, you get $1.25, because there are 4 quarters in a year. So let's just go over that again for those that didn't catch that. If a share is worth $100 and the dividend is $5, you take the $5 dividend percentage and then you divide it by 4, because it's per quarter. That's the bit that people skip. It's per the quarter. So you divide 5 by 4 and then you get $1.25 per quarter or per 3 months. Now, dividends are important because they signal that a company has a stable cash flow and is generating profits. And they also provide investors with recurring revenue. Dividend payouts may also provide insight into a company's intrinsic value. And many countries offer preferential tax treatment to dividends, where they are treated as tax-free income. Wouldn't that be lovely? That is all that this article has to offer, guys. I hope you enjoyed the video and you found it informative and educational. If you did like the video, please like and subscribe, and I'll see you in the next video. Thank you and have a good day.